Okay, good morning again. Let's go quickly overview of chapter 13, which we covered last time. What was that about? We talk about different type of company organization and legally how we can form a business. We have a proprietorship, we have a partnership, and we have a corporation. Corporations are two types. They can be public and they can be private. The difference is how we trade the shares. In the public companies, those shares are traded publicly through the stock exchange, where the private corporation, we don't have access to the shares. Why somebody wants to open a corporation? Because it separates the owner from the business. That once we separate the owner from the business, that business has a continuous line. So the corporation can continuously exist. No mutual agency, limited liability to shareholders, which is limited only to their investments. Of course, the corporation have to pay different taxes and follow different rules, which is part of the disadvantages of being corporation. Now, what's the organization of the corporation? We have those shareholders who only invest money because they want more money. They're the one who choosing the board of directors, which board of directors serves to the shareholders. And if the shareholders wants money, the board of directors makes sure that the corporation generates money for the shareholders. Then the board of directors is going to appoint the president, and president is going to make sure that he satisfies the needs of the board of directors, which is to provide wealth to the shareholders. And keep going, keep going, keep going. But at the end of the day, all the profits going to be taken from the shareholders. That's why we have those shareholders and investors. So now, for the shareholders, they have to hold the shares. Now, the corporation, when it's created, they can issue certificates to the investors or the owners in form of the shares. They have authorized shares, which is the maximum number of the shares that can be issued by the corporation, and issued and outstanding shares. Those numbers are different. Authorized numbers is the number of the shares can be issued through the entire life of the corporation, where the issued and outstanding shares are only out of the number of authorized shares, which one has been issued and which one has been given to the shareholders. Now, on the shareholders' equity, we're going to have two different sections. One will be the contributed capital, which comes from the shareholders, and the other one is the retained earnings. Retained earnings comes from the earnings from the company from the previous periods, which is retained in the company. Retained means kept, earnings means net income from the previous years. So in the retained earnings, we're going to see how much the company generating through the day of the creation of the company, which were kept in the company and not distributed to the shareholders. Issuing of the shares, obviously, well, the first thing is the retained earnings. Retained earnings come from the income. Now, how are we going to do that? We're going to close all the revenue and expense account into account which is called income summary. And for the income summary, we have two options: to have debit balance or to have a credit balance. If the income summary account ends up with the credit balance, that means the revenue is more than expenses, so the company generates income. That income, when it's kept in the company, move to retained earnings. The other option is company to lose money, means the revenue is less than the expenses, then the income summary is going to end up with debit balance, means then the income summary is going to be transferred in that balance from the income summary is going to be transferred to retained earnings, and that's going to reduce the retained earnings or the equity section. That's called deficit. Dividends. The only way the shareholders can take money from the corporation is through dividends. Now, the dividend can be cash, and today we're going to see the other forms of the dividend. What kind of rights the shareholders have depends on the shares that they hold. If they're holding ordinary shares or common shares, they're going to have different rights. But the basic rights are, once I have a share, I can sell it or I can trade it. If I have an ordinary share, I can vote on the shareholders meeting. If I have a share, I have a right to receive a dividend which is proportionate to my number of shares. And if the company decide to close everything that's left on the company, I have the rights for that residual or proportional assets which stay in the company. Now, issuing the shares is through the initial public offering. And I told you, I'm not sure if you have checked this, but please check it. It's very interesting website. I can briefly show you this if you want right now, because today we have probably a little bit more time. Let's do it, and let me show you this, what you can find if you check this website, Cedar. Now I'm going to share my separate screen with this window. Now we can see my, let me see, there we go. You can see my search engine. And what I'm going to do, I'm going to paste this Cedar. And we're going to see this electronic document system. Cedar, this one is the Cedar Plus. Now that's how it's called, Cedar Plus. Once you click on the Cedar Plus, you're going to see something like this. Now, in this website, you can search. As you can see, file disclosure, search for the issuer information, Canadian capital market. So everything, all the companies from in Canada have to host their resources here. You can do different searches here. Let's go with the profiles. If you need the profiles, then you have to go with the search either by name, either by number. Let's go with the Rogers. And let's see what we're gonna, if we do the search, we're gonna have different company with have a Rogers name in their company. And you can see there's so many of them, but Rogers Communication or Rogers Wireless operating Rogers Communication. Probably this is the one that we're looking for. If we click here on this Rogers, let's see what's going to happen. It's going to give us what kind of company is this. Rogers Communication is the public company. That's the profile number, which is registered here. What's the head office address? What's the website address where you can email the company? And on which jurisdiction this company, the principal is, which company this company operates. And keep going. At some point, we may start seeing the documents related to that company. On this page, we can see search and download documents for this profile. Or we can go to the fiscal year end, and here we can see new releases, certification, internal financial reporting statements. If you want to see financial reporting statements and reports for the actual public company, that's the one that we should do. Management, this is the intern management. Can't remember what was D and the A analysis report is. But let's take a look at what exactly is this. I can easily download it here. And if we open it, it's going to give me this report. Let me see if you see my screen. Yes, you can see my screen. And this report, it's going to give us management discussion and analysis report. And again, this is a very interesting reading. If you're interested, really interested, you're going to see here, you're going to find the strategic highlights, financial guidance, or quarterly financial highlights of the company. Let's make it bigger so you can see summary of consolidated financial results, results of reportable segments. Anything that you want to see, it's already here. Key performance indicators. This is all managerial accounting. And there's a combination. The information here provided is for the management accounting purposes or financial reporting purposes. And we can keep going, keep going, keep going. That's not the point here, but I want just to show you that you have this information available. Once we come to the final chapter, chapter 18, financial statement analysis, we can come back here to the Rogers communication, and we can pull out the financial statements, and we can actually see how the Rogers performs. I'm going to stop sharing here, and we're going to move back to our slides and going to continue with our slides. That was the effect of that CEDAR system of electronic document analysis and retrieval. What else we saw last time? We can issue shares for cash. Once we receive cash, we can issue common shares. We can issue cash shares when we receive some assets, property, plant, and equipment. Those are reported at the fair market value, current market value, which raises the ethical question: what's the actual value of the assets that we receive and issue shares? The other type of shares that we company can issue is the preferred shares. Preferred shares are higher ranked shares than the common shares. Why? Because they receive some fixed dividend. On the other hand, they cannot vote. Those are not voting shares. They receive everything before common shareholders. And even if the company is dissolved, preferred shares gets first everything that they have to get, and if there anything left, that's go to the common shareholders. Preferred shares can be, again, it can be issued for cash or can be issued for the assets. Again, those assets, it's going to be on the fair market value. The other thing for the preferred shares, they can be convertible shares, which will be converted from common shares into the from preferred shares into the common shares. I never see conversion from common shares to preferred shares. Usually the lower class shares can be converted into the common shares. That brings us to the shareholders' equity section on the balance sheet. As you can see here, we have two sections on the shareholders' equity: contributed capital and retained earnings. In the contributed capital, we're going to have the preferred shares listed first. Second will be common shares, total, and then retained earnings. So let's see what else is important from this chapter. Organizational cost, how we're going to treat the organizational cost. This one is important in terms of the differences between corporation and corporation, a public corporation, a private corporation, or company that using the international financial reporting standards versus company that using accounting standards for the private enterprises. That's one of the main differences. The difference is that in the international financial reporting standards, you can expense organization cost right away, where under accounting standard for the private enterprises, you have to capitalize those. And once you capitalize them, you can depreciate it within the first year of the operation of the company. Now, the cash dividend, Now, again, dividend is the only way the shareholders to get money from the corporation, regardless what kind of corporation is it, public or private, it doesn't matter. Dividend is the only way the shareholders can get the money. Now, there are two requirements for the company to issue cash dividend. First, company has to have available retained earnings, because if the company don't have the retained earnings, that means the shareholders withdrawing their own capital, which doesn't make sense. So for that reason, or which basically means they're closing the company. So for that reason, in order to declare the company to declare dividend, first they have to be available retained earnings. Second, the company has to have cash. Remember this, if you end up working in the corporation, which probably going to end up one day, and you're the controller, which you're going to be, you're not giving dividend to the shareholders if you don't have excessive cash. You're not borrowing money to pay dividend to the shareholders. That doesn't make sense. And you're not taking from the working capital of the company to pay dividend to the shareholders. So there are three dates which are relevant for the dividend. One is the declaration date. Second one is the date of the record, and distribution date. Declaration date is the date on where the dividend, cash dividend, has been declared. That's the trigger point for the liability. Liability for the dividend. Second point is the date of record. Date of record is the date on which date everyone who holds the shares on that day is going to receive dividend on the distribution date. And the last one is the distribution date where that dividend is actually paid. Entry happen only on the first date and the last date. On the declaration date, the dividend become legal liability, means we're recording the dividend payable, and we're getting the dividend payable from the retained earnings. So we're reducing the retained earnings and increasing the liability as a dividend payable. On the date of records, there's no journal entry. And the last one is the distribution date, when we actually clearing that dividend payable by paying cash. So liability is going to go down, dividend payable, cash is going to go down by reducing the cash. Now, there are the different forms of the dividend. Again, preferred share gets the dividend first. If there's anything left, that goes to the common shares. The first example that we see last time was the $5,000 dividend was declared, and the preferred shares have to take 5,000. In that case, the preferred shares get the whole of 5,000. There's nothing left of the common shares. Second one was the company now declared dividend of 30,000. Then in that case, the preferred share get 5, common shares the rest, 25. Cumulative preferred shares is the one that it's also called dividend in arrears. So when the preferred shares are cumulative and the dividend hasn't been declared in the previous years, that means we have a dividend in arrears, which has to be paid first when the dividend is declared. So in that case, first we're going to clear everything that hasn't been paid yet for the years that the dividend is due for the preferred shares. After that, we're going to clear the dividend on the preferred shares for the current year, and everything else left is going to go to the common shares. Now for the decision making, which one is important? Obviously, the market value, it's going to tell you how the market sees the value of the shares of the company, where the book value is simply the book value of each share, which is the amount of the shareholders' equity associated with every shares. Now, how are we going to get the book value? Book value is very simple. We're going to get first the total shareholders' equity minus the preferred equity divided by the number of common shares. So since we have preferred equity, that means we have to get this preferred equity first, which preferred equity is the liquidation value of the preferred shares plus the dividend in arrears, if there's any, for the preferred shares. Once we eliminate those one, we're going to see how much is the left from the total shareholders' equity. And we're going to divide it by the total number of the common shares outstanding. And this was the example with the, as you can see, the preferred shares, common shares, total contributed capital, retained earnings. And from here, we can calculate the book value of the common shares and the book value of preferred shares. Why do we need that book value? Because we want to compare the book value with the market value. Which one is more powerful? Obviously, the market value is more powerful. Then if the market value is less than the book value of the company, that means the company is understated or undervalued. Means if you buy the shares, the company does, most likely the market is going to adjust and you're going to get richer. Now, the two things that we missed last time was the return on assets and return on equity. Return on total assets and return total equity is the number that tells the investors how much they get from the assets for every dollar that they invest and how much they get from the equity for every dollar that they invest. So in this case, return on the assets is measured by total net income plus the interest expenses. Remember, in the net income, we already eliminated the interest expense. So we're going to bring back the interest expense and we're going to delete this from the average total assets, which will be the beginning, plus the ending assets divided by 2. And that's going to give us a return on assets. So for every dollar that we have invested, how much is our return in terms of assets? Or from every asset that we have, now having in mind is that the assets come from initially from the equity. That means for every asset that we have, how much we're generating, how much income we're generating. This company, for every dollar of assets, they're generating 3.88%. The return on the equity, that's the one for every dollar that I invest, how much I'm getting. That will be the net income minus preferred dividend divided by average common shareholders' equity. Again, we're going to get the beginning minus the ending divided by 2. Plus the ending divided by 2. That will give you the idea for every dollar that you invest in, how much you're getting back as an income. So these people, they're getting 5.31% on the dollar. Leverage. Usually the return on equity is greater than the return on asset. Now, the most company which borrow on one rate and invest at the higher rate of the return, and that is called using the leverage. Means that if I borrow on the lower rate and generating on the higher rate of return, then obviously you're generating profit just for the difference of the rates. Now, International Financial Reporting Standards. In the International Financial Reporting Standards and Accounting Standard for the Private Enterprises, I'm not going to spend too much time, but since all of you most likely are going to continue with accounting further in your study, I strongly suggest you those final slides from every chapter to take a snapshot or to have it somewhere saved so you can see the differences between one standards and the other standards. Right now, you don't have the idea about the International Financial Reporting Standards, but in the next course that you're going to take, intermediate financial reporting, it's under international financial reporting standards, first part. And then you're going to start, everything's going to start making sense. Right now, we're seeing everything from the perspective for the accounting style for the private enterprises in this course. So that was the missing piece from the last chapter. And now I believe that gives you a little bit overview, whatever we talked about last time. Now let's go and see what's for today. That will be chapter 14. Open it, open, and let's start with chapter 14 now. Now, once we know what the equity is, the two sections of the equity, contributed capital and retained earnings. Let's see what's waiting for us here. Now, retain, what we have to recall, we already recall everything about the two sections, two components of the equity, which is the contributed capital and retained earnings. Again, contributed capital comes from the preferred shares and common shares, where the retained earnings comes from the net income. And the thing that reducing the retained earnings will be the dividend. Now, the other thing is owner's equity of the corporation is called shareholders' equity. Now, today, we're going to compare, we're going to take the corporate equity a little bit further. What that means is in the up to this point, we're talking about the contributed capital, how we issue the shares, how we declare dividend, cash dividend, and what's the corporate balance sheet look like. Where in today's chapter, we're going to talk about the retained earnings, what's in the retained earnings, what increasing the retained earnings, what reducing the retained earnings. We're purchasing the shares. So last time we saw how we issue the shares. Today we're going to see what's going to happen when we purchase those shares back. We're going to talk about other forms of dividend, share dividend, and share split. And the last one, again, we're going to see the corporate income statement, since we already see the balance sheet. Now, let's go first with the first objective, with the share dividend. No, we went too far. So first we have to see the, accounts for the share dividend, share split. Retained earnings. What's the retained earnings? Retained earnings, obviously that's a T account. Let me open one Excel spreadsheet. Or maybe I should open the Excel spreadsheet that we started last time. Let me see if I can find it quickly. Get that Excel spreadsheet and work with that Excel spreadsheet. So we can keep everything, and I'm going to post it later for you, so you can have access to it as well. I believe this is the one, but let me see. Yes, that's the one. So let me share my screen with the Excel spreadsheet. And I'm going to show you quickly what's happening with that retained earnings. Now, that's the Excel spreadsheet. Let's start chronologically with everything. First, we're going to have this basic accounting equation, which again is equal to asset. Let's keep a little bit space, equal to liability plus equity. And what we saw on out of this equation, on the equity side, we have two components. We have contributed capital and we have the retained earnings. Now, the contributed capital comes from the preferred shares and common shares skip it here, common shares. Where the retained earnings, it's interesting part. That's where we're gonna spend time today, a little bit. If we have to create that T account for the retained earnings, it's gonna look like this. Now the retained earnings in the very first year, it will be zero. Let's make it clear. The very first year is gonna be zero. Since we base on this T account format, which I showed you last time, for the basic accounting equation, if this is on debit side and this is on the credit side, means that everything on the credit side has a normal balance. Right? That means the liability and equity section is going to have normal balance credit. Well, the retained earning doesn't make any differences, so stays with that line. So that means on this side will be our credit, on the other side will be our debit. That means the retained earning accounts normal balance always going to be credit. So this side is going to be most likely is going to be the beginning balance. Now, if it starts a brand new company, the beginning balance in the very beginning is going to be zero. Now, the question is, what's going to move this balance and increase that balance? Since we're starting with zero. Well, let's think about it. We already said that the retained earning is affected by the net income. If the company generates a net income, that's going to increase the retained earning account. Now, what's going to decrease the retained earnings? That will be the net loss. If we have net loss, that's going to decrease our retained earnings. The other thing that's going to decrease our retained earnings will be the dividend. If the company declared dividend, that's going to decrease the retained earnings. Today, we're going to see which dividend is going to decrease the retained earnings. Cash dividend definitely is going to decrease the retained earnings. We're going to see the other form of dividend, which one of those is going to decrease the retained earnings. And at the end, we're going to check what's the ending balance for the retained earnings. And that will be our T account. And that's the retained earnings. Those are the events that generally happen into the retained earnings. Start with the beginning balance. Then whatever happened during the period happened, ending up with the ending balance. And in the middle, we're going to have the events which happen and this retained earning account. Again, net income is going to increase the retained earnings, net loss is going to decrease the retained earnings, and dividends also is going to decrease further the retained earnings. Now, knowing that, let's go back to the slides. And repeat the same thing from the slides. The slide's not going to give us anything different. In contrary, it's going to give us exactly the same. Let's push this one down a little bit. In retained earnings, now the balance is accumulated over the lifetime of the company. That will be all the net income minus all the net losses, minus all the dividends declared. Retain means kept or hold onto, which means that stays within the company. Debit balance in the retained earnings, it's called deficit. Deficit of what? Deficit of earnings. Means those have to be covered by somebody. But who's going to cover the deficit? Obviously, the shareholders. Credit to retained earnings, arise only and only from the net income. Retained earnings is not equivalent to cash. So that means if we have $10,000 retained earnings, doesn't mean we have $10,000 cash. Why is that? Because we're running accrual account. If we run the cash accounting, then yes, those will be equivalent. Ending retained earnings balance is equal to the beginning balance plus the net income minus the net loss minus the dividend, and we're going to get the ending balance. Now let's see how we're going to declare the dividend. Now, in order again to declare the dividend, cash dividend, we have to take it from somewhere. From where we're going to take it? From the retained earnings. Basically, what that means? That means the shareholders want part of the earnings in the company. So if they take it from the company, means it's no longer in the company. That means moving to their own hands. And then you're going to see for the tax purposes, what's going to happen when the dividend move from the corporation into the individual hands. Again, we're going to have the beginning balance. We're going to have the net income for the year. Net loss, obviously, you cannot have in the same year net income and net loss. That's impossible. And if you have net income, obviously, you may want to declare dividend to keep the shareholders happy. And whatever left in the company, that's carry forward to the next reporting period. Now, the share or stock dividend. Why the company wants to issue stock dividend? First, share dividend is a common thing, but it's going to increase the shares, common shares, and you're going to decrease the retained earnings. It's going to affect the shareholders' equity. Means overall picture of the shareholders' equity is going to be zero, but it's going to increase the share capital and it's going to decrease retained earnings. But overall, in the retained earnings, it's going to stay zero. Effect will be zero. Now, why the company wants to declare a share or stock dividend? Let's see. First is to continue to give dividend to the shareholders. The other reason is because the company may simply not have cash. The other reason is maybe the company wants to reduce the market price per share. How is that possible? Well, by giving the share dividend, we're technically increasing the number of shares. And if we're increasing the number of shares, market price most likely will adjust and going to be reduced. Because now we're going to have more shares available in the public hands. Now, some of the shareholders might disagree with that, but when we declare share dividend, we're going to give a same proportion of the shares. So whoever owned 20% before the share dividend, he's still going to own 20% after the share dividend is declared. Now, how are we going to do that? How are we going to declare that share dividend? The example here is, let's assume this company declared 10% share dividend on 75 outstanding shares. So those 75,000 outstanding shares, every shareholder is going to get 10%. That's for every share, we're going to get 10%, 0.1 part of the shares. So the total new shares that we're going to issue will be 7,500 new shares. Now the question is, what will be the value of those shares? Now, we're going to check the market value. And based on the market value, we're going to come up with the price or the value of those 7,500 shares. So what's going to happen in that case? The common shares, it's going to go up, and the retained earnings is going to go down with the exactly same amount. So before the issuing the shares, let's see here, we had 10,000, 100,000 common shares, and retained earnings was 150. After the stock dividend, now those 11,250 move from the retained earnings into the common shares. So what's happened here? Common shares went up with 11,250. Why? Because those additional 7,500 new shares which were issued. So the number of shares moved from 75,000 to 20,500 shares. Retained earnings went down with 11,250, or the same amount that the common shares went up. So the total shareholders' equity is unaffected. Be careful and watch for those questions if you can see any this type of questions on the quiz. That's a tricky part when you have a stock dividend. What's the effect on the total equity? Obviously, the effect on the total equity is zero. Why? Because the total shareholders' equity, that hasn't changed. It's not going to change. Again, the amount of retained earnings transfer means what that means is when we declare the share dividend, we capitalizing the retained earnings. Means we keeping the retained earnings within the company by adding more value to the common shares, book value to the common shares. Once that is done, we don't have to declare cash dividend because again, we just delivered the share dividend. Now, reasons again to continue the dividend, but not giving up cash. Reduce the market price of the shares. Increase the supply will likely reduce the market price. So basically, once we put more shares into the open market in the hands of the shareholders, the market value may go down. And why we need the market value to go down is maybe because we want to make our shares more available to the basic population of people who don't have that much money. Recording the share dividend. Now, the recording of the share, again, we're going to have those 3 dates: declaration date, date of record, and distribution date. Now, as you can see here, compared to the cash dividend, in the cash dividend, we have declaration date, date of records, and payment date. Here, we don't have a payment date. Because we cannot pay share dividend, but we're going to distribute the share. That's why the 3rd date is called distribution date. So, declaration date is the date that the board of directors decide to declare the stock dividend. Date of the records is who's going to get that stock dividend. So on that date, we're chasing who is the owner of the share, and those are the ones who are going to get that stock dividend. And distribution date is the actual date when the shareholder is going to receive that extra shares. Valuation of the share dividend is usually based on the market value on the declaration date, which obviously will be suggested by the Canada Business Corporation Act, which every company has to follow. We're talking about the public companies here. Example will be this company has 40,000 common shares. Now they declare 10% common share dividend on November 17th, when the market value of the shares was $16. Now, they will distribute 4,000 shares on December 12th. Now, the following entry is going to be made on the declaration date. Now, we're going to have retained earnings. We're going to reduce the retained earnings, and we're going to go with the equity account, not the liability account. This will be the equity account called common share dividend distributable. One thing I want you to remember, and please remember it, share dividend on the declaration date is not a liability. That doesn't trigger the liability point compared to the cash dividend. Only the cash dividend on the declaration date creates a liability for the corporation. The share dividend, it doesn't create a liability. Why is that? Because that share dividend can be canceled anytime before the distribution date. For that reason, the share dividend is not a liability. That's why we're not using the liability account. We're using simply equity account, which is called common share dividend distributable. Now, on the date of record, there's no journal entry. On the distribution date, we're going to replace one equity with another equity. Common shares dividend distributable. It's going to go down or eliminated. Common shares going to go up. As you can see here, never create that share stock or share dividend, never create liability. Now, what will be the comparison? Comparison before the dividend, we're going to have 40,000 outstanding shares for $400,000, assuming the book value is, that will be $10 per share. The retainer is 800,000. That's before the dividend is declared. Once the stock dividend is declared, number of shares going up with 4,000. The value of the shares also goes up with the $64,000 additional. With $40,000 additional, we're going to take it from the retained earnings. Now, one thing that I want you to pay attention is on the multiple choice question that you may see, it might trick you by asking you questions like, after those, what changed after the shareholder share dividend? Option A, total shareholders equity change with, let's say, company declare $64,000 stock dividend. What change? Option A, total shareholders equity increase with $64,000. Option B, total contributed capital increase with $64,000. Now, option B will be the right one because the total shareholders equity, again, that's not going to change. But the total contributed capital went up with $64,000. Why? Because that retained earnings moved from the retained earnings into the common shares. And when we're adding this, you're going to see that you can see that the total contributed capital actually increased with $64,000. But the total shareholders equity hasn't changed. Don't get my point is here. Once you see the word total, don't stop there. Keep reading and pay attention because the total contributed capital is not the total shareholders equity. Make sense? Contributed capital is part of the total shareholders. That is true. So that's why when we combine the contributed capital plus the retained earnings, giving the total shareholders equity, which is not effect. There's no effect on the assets and the liability side. The journal entry or this effect on the share dividend is affecting only the equity section. Now let's see what's the share split. Share split is simply splitting one share into the other number of shares. We can split one share by 2. We can split by one share by 4. What we're going to do with that, we're going to simply increase the number of authorized and outstanding shares. What we're going to achieve with that? We're going to achieve reduction of the market price per share. Imagine this. Today, the company has 5,000 shares issued and outstanding, which are traded on the open market for $100 per share. I'm doing the share split, means for every share which is outstanding, I'm splitting it into 4 shares. So that means I'm gonna not double, not triple, I'm gonna quadruple the number of my shares. So instead of 5,000 shares, now every shareholders, when you combine those $5,000 now will be 20,000 shares. Well, if the market price was $100 per share when they're 5,000, we should apply the same logic. Now, if we have $20,000, most likely the price, total price, as you can see, 5,000 times $100 per share, that's going to be 50,000. Now the market value total also going to be 50, but instead of 5,000, it's going to be divided by 20,000 shares. So the price is going to go down to, what will be the new price? $25 per share, correct? And that's how we're going to get another $50,000. So all account balances and total shareholders' equity is not going to change in this transaction or this event shareholder split. There's no journal entry that has to be done when we have a the share split. And the split is recorded only and only as a memorandum or memo entry. Example will be corporation has 400,000 shares issued. The market price is $100. We want to reduce the market price to $50 per share. For that reason, we're gonna split the common shares for 2-to-1. So instead of having 400,000 shares, we're gonna have 800,000 shares. So most likely the price per share is gonna go down to $50. Why are we doing this? Because we want to reduce the market price of the shares to make our shares more affordable for the common people. How this gonna look like on the equity section of the balance sheet? Well, as you can see, first we have 400,000 share issue and outstanding. After the 1 million authorized, now we have 2 million authorized. We double it, and 800,000 shares outstanding, issued and outstanding. The value is not going to change. The book value of the share is not going to change. I mean, the book value per share is going to change, but the total value of the share is not going to change. Retained earnings is not going to change. Total shareholders' equity not going to change. Now, can we do reverse split? Yes, we can. Means we're going to reduce the number of shares. If we reduce the number of shares or decrease the number of shares, what we're going to do? We're going to increase the market price of the share. So, for example, if the market price of the shares is $10, but we want to increase it to 20, we're going to reduce to the reverse split. We're going to reduce the 2 times the number of shares, and that we expect to increase the market price per share. Now, what's the similar and what's the difference between the share dividend and share split? First, similarities are that both increasing the number of shares. Both, there's no exchange of the cash. No cash is involved. Increase the number of shares issued by the corporation. Also, will likely initially cause a decrease in the share market price per share. Now, neither of those dividends are going to change the investor's total cost of the shares sold. So basically, there's no effect on the cost for the shareholders. What are the differences is the taxation. So watch this. If you decide to give shareholders stock dividend, That's taxable. When you do the stock split, there's no tax effect. But again, if you decide to declare stock dividend, your shareholders will not gonna be happy. Why? Because they have to pay taxes on something which they haven't received cash. If they get the cash, they can pay the taxes. They have the cash to pay the taxes. But in this case, you give them earnings from your retained earnings, but you don't give them cash, which is taxable. So imagine this, I'm receiving $7,500 stock dividend from the shares that I own. Well, now I have to pay taxes, but I haven't received cash. So from where should I get the cash? Well, from my savings, obviously. Or if I want to get the cash, I have to sell the shares that I have in order to get the cash. The other thing is the share dividend shift the amount of the retained earnings to the contributed capital. And the shares split doesn't affect the account balances. As you saw, nothing has changed. Let's move to the next one. What's going to happen when we repurchase shares? We saw what's happened when we issue the shares. When we issue the shares, we get the cash, we keep the shares. Now, later on, we want to purchase those shares that we issued. We want to purchase them back. What's going to happen in that case? For this reason why the company wants to purchase the shares. First, we may need to recover some of the shares that we already issued. Second is to support the share current market price. It means that by pulling out the shares from the market, we're going to increase the demand. The other thing is why the company will start buying its own shares is maybe because somebody actively tried to get a high percentage of the shares, so he or she to take over the company. So that's why the corporation take steps to avoid that. And we may need to make some shareholders requirements on some shareholders requirement limits. Now, Canadian Business Corporation Act require all the repurchased shares to be destroyed or cancelled. So they may be restored as authorized, but unissued. Generally, a purchase is only allowed if the corporation has sufficient cash. So if the corporation has sufficient cash, yes, the corporation can buy its own shares from the market, and once they buy them, they have to cancel them. Repurchase shares will decrease both corporation assets because we're using fresh cash, and it's going to reduce the shareholders' equity. Once we reduce the shareholders' equity, that's for the remaining shareholders, that's better because they're going to get more of the retained earnings or the dividend later declared by the company. In some provinces, there's a requirement the repurchase shares to be cancelled, but in some provinces they allowed those to be held as treasury shares. So if you see question about treasury shares means that shares which are repurchased but not reissued yet or held by the company, which are available for resale. Those are the treasury shares. Now, let's see the example. Now, this company has the following shareholders' equity. They have the contributed capital, $180,000. They have the retained earnings of $24,000 and they have shareholders' equity of $204,000. Now, at this point, if we ask what's the average issued price per share, what we have to do, we have to see what's the value that's sitting for the common shares and how many common shares was issued. So we have $180,000 value of the common shares. For 9,000 common shares issued and outstanding, what's the average price, issue price? That will be $20 per share. Make sense? Are you guys with me?
Yes, bro.
Yes,
Okay.
Professor.
Let's copy this information. You know what? Let's copy this information and move it to Excel spreadsheet. Let's make it more interesting today. Only, talking, going over the slides. That's a good thing, but let's do some thinking and some journal entry on our own as well. And let me copy this one as well. And I'm gonna move this one to the Excel spreadsheet. And we're gonna play with the different scenarios. I hope that's gonna help you to understand better the idea. So option first is we repurchase. Let's get this one first. First scenario is this. Let me stop the sharing and let's go to the Excel spreadsheet now. I have it in the Excel spreadsheet. I'm gonna share my screen and you're gonna see the Excel spreadsheet. All right. You should be able to see the set, correct? Can you guys see it?
Yes, Professor.
Awesome. So now, this company had the following shareholders' equity on February 2023. Contributed capital, common shares only, 100,000 shares authorized, 9,000 shares issued and outstanding for $180,000. Retained earnings, $24,000. Total shareholders' equity, $204,000. Now, on March 20th, the company repurchased 1,000 shares at $20 per share. Now, what will be the entry? Obviously, the entry is going to have debit and it's going to have credit, correct? Since it's journal entry. Now, the question is, if we repurchase $1,000 shares at $20 per share, we have to give something to those shareholders, correct? What we're going to give them? If you want to purchase, let's say I'm purchasing 1,000 coffees, but one coffee costs $20 per coffee, what do we have to give the people to get those coffees? I have to give them cash, right? So we're going to create cash. How much cash we're going to give? Well, we're going to give 1,000 shares times $20 per share. It's going to be
20,000.
how much?
20,000.
20,000. 20,000. Now, why we pay 20,000? We pay 20,000 because we repurchase 1,000 shares, correct? We repurchase 1,000 shares. Now the question is, those shares, when we issue the shares, how much money we get? And what's the average price per share right now at the day of the repurchase? Make sense? So how are we going to get that? Well, obviously, the way they suggested before, what we're going to do is I'm going to insert some lines here. gonna push this one down and we're gonna see what's the average price per common share at the day before the repurchase. So we have $180,000 and we have 9,000 outstanding shares. So my average price per share is equal to 180 divided by 9,000. Or that will be $20 per share. Now I'm purchasing back those $20, 1,000 shares, but the average price per share in this case is $20 time $20. Not because I'm paying $20. Do you make the difference? I'm not paying $20. I'm not the debit here is 1,000 shares time $20. It's not because I'm paying $20, but because my average price per common share is $20 based on the current situation in the company. Can be different, but magically this time is the same. So I'm going to reduce the common shares with 1,000, and since the average price per share is $20, I'm going to repurchase back 20,000 as a dollar amount, and I'm going to pay exactly the same amount. So in this case, life is beautiful. Whatever I purchase is equal to the whatever I paid. Debit is equal to credit. We're done. Make sense? Are you guys with me?
Yes, bro.
So once I do that, what's going to happen? Let me check how the slide's going on. Just give me a second. So I want to see how they're going. So I can adjust to what they do and we can keep doing the same. So what's going to happen in this case? After this transaction, what we're going to have? We're going to have a shareholders' equity. Which is constituted by the common shares. In this case, we're going to have only, since we purchased 1,000, now we're going to have 9,000, 8,000 outstanding, correct? Are you guys with me? So now we're going to have only 8,000 outstanding, issued, and outstanding for the total amount of, now there was 180, now that's going to be 180, that's going to be 160,000. Retainer is not going to change. We're going to have common shares. That will be, let's do something else here. Let's go here with contributed. Then that's the contributed capital. The next section that we're going to have, that will be retained earnings. Retained earnings is not going to be affected. We're going to have exactly the same retained earnings of 24,000. And the total equity will be calculation of those two. or it's gonna be $184,000. That's very straightforward. Do you see anything scary here? Anything scary, guys? Or it's all good?
All good, Prof.
Okay, so let's keep going. Let's make it more fancy. There you go. Now the second scenario. Gonna get this one. Actually, I'm just gonna copy the entire worksheet. And I'm gonna move it here. So now in the second scenario, this one, it will disappear. And let's see I'm gonna copy from the slides, and then we're gonna go back to the slides. Once we review the slides again. Second scenario will be let's do it together. Let's push this one down a little bit. Take this one. Cash probably is gonna stay, but let's see. Now, second scenario, on April 30th, we repurchase 1,000 shares, but now we paying $15 per share. Now the question is, how much cash we have to pay? Well, if you purchase 1,000 shares at $15 per share, now in this case, we have to pay only
15.
15,000.
15,000.
That's no questions about it, correct? That's very straightforward, very clear. Why are we paying 15,000? Because we buy common shares.
Yes.
Now, how many common shares we buy? 1,000. Now, the question is not how much we pay for them, but what's the average issue price for all the shares that we have up to this point? Average price is $20, correct? So we're buying shares, which the average price is on our books is $20. Sorry, not this one. It's got this one. $20. That will be, I'm looking for the dollar sign here. Let's put this dollar sign like this. And now we have, whoops, wrong place for the dollar sign. Let's fix it. Dollar sign, $20. So the value of the common share that we're repurchasing is 20,000.
20,000. Yeah.
Right. Now we have a problem, correct?
Mm-hmm.
Not this one, sorry. I want to insert some rows here. Let's insert some rows. We have a problem because our debit is not equal to our credit. What do we need? More debit or more credit?
More credit.
More credit. How much credit we need?
5,000.
5,000.
5,000. Right.
5,000.
Okay. So we put the 5,000. So we get it. We balance the entry. We balance the entry. Debit now is equal to credit. The question is, which account we gonna credit? Now listen, stay with me here and listen to me carefully.
Okay.
Okay. What is gain?
Profit.
Debit.
Is it? Is it? Is gain equal to profit? What do you think? Is that true?
Yes.
Are you sure?
I think so.
You think so? So then what the profit is? How do I get profit? Talk to me, people. How do I get profit? What is profit? Help? Do you need help?
Income minus expenses.
Say that again, please.
Income minus expenses.
Income minus expenses. What is income? Income?
Revenue.
Okay, then I agree. Revenue minus expenses is going to give us profit, correct?
Yes.
Or profit will be equal to income. Correct? In accounting, we call it net income. Make sense?
Yes.
Now, if the profit is equal to income, is profit equal to gain then? Can I say the gain is equal to profit and gain is equal to the net income? Is that true? What do you think? Yes, no?
Yes.
Actually, it's no.
Sir.
Profit, yes, profit is equal to income, but gain is not equal to profit. Gain is something else. So now let's see what the gain is. From where the gain coming? Question for you. Listen to me carefully. Yesterday, I bought
Mhm.
apartment for $500,000. Do I have gain or do I have loss?
For what's the expenses for the apartment?
I bought it $500,000. I pay $500,000 for the apartment. Do I have gain or do I have loss?
Loss in cash.
So, Professor,
Any others?
what is the original price of the apartment?
$500,000. I just bought it yesterday.
Oh, yesterday. How about the? Oh, okay. Rep,
Do I have gain or do I have loss?
Both.
Any other suggestions? I'm gonna give you another example. Every time when I go to Bulgaria, I'm giving my mom money, Canadian dollars. 1 week later, she's calling me and she said, I lost money. And I say, how? Well, the exchange rate of the Canadian dollar went down. And I'm asking her, did you sold the Canadian dollars? She said, no. Then how did you lose money? 2 weeks later, she's calling me again. Oh, now I'm gaining money. I said, how come? Well, the exchange rate went up. Now Canadian dollar worth more. Did you still have the Canadian dollars? Yes. Then how did you get the gain? So again, yesterday I bought apartment. Do I have gain or loss?
No gain, no loss.
Why?
I think
Because you hasn't sold the apartment. So
Aha. Okay. So what do I need to have before I have a gain and loss? What do I have to do? I have to sell the apartment, right?
yeah, you need to sell that, and then you
Once
can
I sell the apartment, then
gain
I
the
can
gain.
see, do I have a gain and loss? Make sense?
Yes. Yes.
So if I sell apartment for 550,000, then I have a gain
So you have a gain
of
50,000.
50,000. Make
Yeah.
sense?
Yes, Professor. Additional
Okay.
points.
Right. So what that means is in order to have a gain or loss, we have to see for how much we sell the things, how much we bought it, and how much we sell it. When we compare those two, we're going to have a gain and loss. Now, let's go back. So what do we need? We have to sell it. We have to see how much we bought it, and then we're going to have the gain and loss. Now, in our case here is a little bit different, right? First, we sold the shares. Right? First, we sold the shares. So first we have to buy it, and then we have to sell it. First is buying, second is selling, and the third is gain and loss, correct?
yes.
Professor.
Now, in this case, first we sold the shares for $20 per share.
Okay.
$20 per share. Now we're buying them back for $15.
$15.
Do I have gain or loss?
Gain 5,000.
So no. So before you jump to this, let's go back to here.
Okay.
I have a gain because I bought the apartment for 500,000 and I sold it for 550. Make sense?
Okay.
Yes.
First I bought it, then I sold it. Now here with the shares is the different. First I sold the shares,
Okay.
then I bought them back.
Okay.
Do I have gain or loss?
Gain.
Do you want me to give you another example?
Gain.
So what do you want me to give you another example?
I think there's no gain yet.
So let me give you another example. Imagine this. I have my laptop.
Yes.
I'm selling my laptop to you. So watch this. I bought my laptop for $50.
Oh, so loss
So
5,000.
listen. I'm buying my laptop for $500. I'm
Oh.
selling it to you for 1,000. What do I have? Gain.
Or
I
no.
have gain.
loss
I have no. I bought it for 500.
500.
I'm selling it to you for 1,000.
You bought 500 and then you selling
I
it
buy for
500.
500
Okay, and then you lost 400.
and I'm selling it for 1,000.
You lost
Then it's a
400.
gain.
I have gain,
Yeah.
Okay.
Yeah.
500.
right?
Sale 1,000. Okay.
I have gain 500.
Yeah, you get 500.
500.
500. Clear? Everybody's
Okay.
with me, right?
Yes.
Yeah.
Now, I'm buying it back from you. I'm buying it the same laptop that I sold you for 1,000. Now I'm buying it back for 800.
Buying it.
Make sense? So now I'm selling it. I sold it for you for 1,000,
Yes.
and I'm buying it back from you for 800,
Okay.
right? Do I have gain or loss?
Loss.
Loss,
Loss of
200.
No, no, no. Listen to me
Oh.
carefully.
Gain,
It's
gain.
I
200.
I
think so.
I
Gain.
sold it to you for 1,000,
Yes.
and then I'm buying it back from you for 800.
Gain of 200.
Gain of 200.
It's a gain.
So that's the point here. Is it a
Yes.
gain? Is it a gain? This is the big question here. Is it a gain? Now, again, the gain is the sales price minus the purchase price.
Profit.
Again, profit is X revenue minus expenses. Are you following me here? Can you picture this?
Okay.
Gain is when you buy something and then you sell it higher.
Okay.
Now we have different events. I'm selling it first higher, and then I'm buying it back from you for the less money. Now that's neither gain, neither loss, because I can generate gain and loss when I sell it back. Make sense? So what exactly is? Well, imagine this. I give you my laptop, you give me $1,000. Now I have $1,000. I don't have laptop. But I'm buying the laptop back from you for $800. So now I have the laptop with me. I'm going to give you $800, but I can keep the $200 that you pay me before for the laptop. Make sense?
Yes.
If I sell again the laptop, then I'm going to have gain and loss. But since I'm buying it less from what you pay me for that laptop, I'm keeping that difference. And that, in this case, is called contributed surplus. Make sense?
It's contributed surplus.
Surplus.
Okay.
Why? Because you pay me $20 per share.
Mm-hmm.
Now I have you $20.
Okay.
Now I'm asking you to pay me, to give me back the share, but I'm offering you $15. And you say, okay, now I'm paying you $15 back. So I keep the $5 that you gave me from before, I keep it for myself. And that's called contributed surplus. Make sense?
Yes.
It's not gain, it's not a loss, it's not profit, it's contributed surplus. Why? Because I'm buying cheaper something that I already pay you more expensive. Make sense? I'm not buying and selling, I'm selling and then buying back. Are you following me here?
Yes, bro.
Yes.
Okay, so
Yes.
now what's going to happen with our shareholders' equity now in this case? Obviously, the common share is going to go down with 20,000. From 180, they're going to go down with 20,600. Now we're going to have here new things before we go to the retainers. Now we're going to have a new element, part of the contributed capital will be contributed surplus related to the common shares. That will be common shares, and that will be 5,000. Now, the retainer is not going to change. The total here is gonna be 189,000. Make sense? What's happened with our total shareholders' equity? Went down with only 15,000 because the 15,000 is the cash that we paid.
Okay.
We're gonna keep the $5, the difference between 20,000 and 5,000, we're gonna keep it. And that's gonna create that contributed surplus, which is related to the common shares. Okay? Now let's see the next scenario. Now we created something new. We learned something new that let's delete this one because this one is irrelevant right now. And let's keep going. The next scenario is you go to the slides and pick up the next scenario. This is the next scenario. Can you guys see my screen?
Yes.
Yes, bro.
Okay. In the next scenario now, first what we have to do. First, we have to calculate how much is the average price per common shares. Let's do that first. Oops. How much is our average price per common share? Now we have a common shares which is sitting 160,000, correct? But the number of the shares now are only 8,000. So our average price here will be 160 divided by 8,000, or again $20 per share. That's the average issue price. Now in this case, on May 10, we repurchase 1,000 shares at $30 per share. So let's do the journal entry. Debit. Obviously, we purchasing common shares. And we getting common shares. Now we have to pay for those common shares, and we have to pay cash. And we paid the cash. How much cash we paid? We purchased 1,000 shares, and we paid $30 per share. Correct? So in total, we paid 30,000. Correct?
Yes, bro.
Okay. So now, how much common shares we purchased? We purchased 1,000 common shares. What's the average price per our common shares? It's $20. So we purchased common shares for 20,000. Okay, that's good, but we have a problem. What's our problem? Debit is not equal to credit, correct? So in this case, what do we need? Debit or credit?
Debit.
Debit. So in reality, what happened? We get $20 per share, but now we're paying more than what we get. Make sense? So the rule is when we pay more than what we get, the rule is very simple. First, if we have contributed surplus, we have to bring the contributed plus to zero. If we still have a difference, then we can take from the retained earnings. So let's follow this rule. First, let's debit contributed surplus.
Yeah, contributor surplus.
Do we have contributed surplus? Yes, we do. How much we have? 5,000. Let's get the 5,000. Is that solve our problem?
No.
No.
No, we need more. So,
Yes, it is a blueberry pie.
so the next thing that we're gonna take, it will be from the retained earnings. How much we're gonna take from the retained earnings?
5,000.
Another $5,000. And let's see now what's gonna happen with our shareholders' equity statement here. First, contributed capital is gonna go down with 20,000, correct? It's gonna be 140,000. And number of shares is gonna go down, it's gonna go down to 7,000. Because we purchased back 1,000. Contributed surplus will disappear, that's gonna be 0. So that will be the only thing. Now, what's gonna happen with the retained earnings? Retained earnings is gonna go down with 5,000. So it's gonna be equal
90.
to this 24,000 minus this 5,000. It's gonna go down to 19,000. So the total shareholders' equity is gonna go down to 59,000. Now let's compare this one. So the previous shareholders' equity was here. I'm gonna put it here. It's gonna be was 189,000. Now the new shareholders' equity went down to 159,000. How much is the difference?
30,000.
Why is 30,000? Because the 30,000 is equal to the cash that we paid. Make sense?
Yes, bro.
And it's always going to be like that. If we see here, let's do this picture here. Our total shareholders' equity in the very first time was 204,000. And that $204,000 went down to 189. How much is the difference here? It's 15,000. Why is 15,000? Because that's how much cash we pay. Make sense?
Yes, bro.
Thanks, bro.
Okay. So, what we can take from here? We can take this. If we pay less than what we already issued the shares, we're creating surplus. We're creating contributed surplus. If we paying more per share than what we get, then we have to reduce the retained earnings. After we wash out the entire contributed surplus related to the shares that we purchasing. So we may have contributed surplus for the common shares. We may have contributed surplus for the preferred shares. We're not mixing those contributed surplus. We keep them separate. For the preferred shares, they have their own contributed surplus. For the common shares, they have their own contributed surplus. You can offset only contributed surplus for the preferred shares when you purchase back the preferred shares. Same thing with the common shares. We can use the contributed surplus for the common shares only when you repurchase back common shares. Make sense? Once that contributed surplus for the shares that you purchase in back goes down to 0, then you start using the difference from the retained earnings. If you don't have a contributed surplus and you pay more then the price that you issue the shares, you go then directly to the retained earnings. Make sense?
Yes, bro.
Okay, now let's go back to the slides and let's see how this is covered by the slides. Let's repeat this one more time so you can see the whole beauty of the scenario. Let me share my screen, and once we cover this, I'm going to let you for break. So the first scenario was my getting the average price. We have $180,000 common shares. For that 9,000 common shares, that's $20 per share. First, we purchased 1,000 shares for $20. Exactly how much is the average price? So there's no creation of contributed surplus. There's no creation. We don't need to use the retained earnings because debit is equal to credit. We end balance, move on. Next scenario. We purchase the common shares for $15 in this case. That means we're paying less than what we get. So we're keeping $5 per share. So we're keeping 5,000. Well, that keeping of the money, it's called contributed surplus. So we're gonna pay the $15,000 cash. We're gonna cancel those common shares, 1,000 common shares, $20 average price. We're gonna get them back. And to balance the entry, we're gonna create a contributed surplus for $5,000. Now, the contributed surplus, again, is reported as a part of the contributed capital along with the share capital. Now, they're going with this. Now, before the purchase, since first we purchased the 1,000 shares for $20, but there was no difference. Now the shares went down to 8,000. So the total is 160, retained earnings is the same, 2,408. Then we purchased another 1,000. So in this case, the shares went down to 7,000, which value is 140,000. They created this contributed surplus for 5,000. Retained earnings stays the same, 24,000. Difference between this one and this one is exactly 15,000, which is the cash that we pay for the purchase of the common shares. Nothing more, nothing less. Now the next scenario. Sorry, that was the first, that was the second, and the next scenario is this is the creation of the contributed surplus. The last scenario is when we're paying more than the average price per share. Here we're paying $30 compared to the $20 average price per share. So the cash we're paying 30,000, we purchasing back and retiring 1,000 shares at the average price of $20, the one that we initially get. So those are gone. Now we have difference of $10,000. First, we're gonna clear the entire contributed surplus related to the common shares, 5,000. And once we do that, we're gonna go, the remaining, we're gonna take it from the retained earnings. Once we do that, we're gonna have the following after the purchase here, sorry. I'm gonna go down, and after the purchase, in this case, we're gonna have, now it's only 6,000 shares left, 120,000. Contributed surplus gone. Retained earning went down with 5,000. And total shareholders' equity is 139,000. Previous was 169. The difference here is 30,000, which is equal to the cash that we paid. Let's reduce it a little bit, and let's go back. So, when we purchase repurchase shares at the price above the average issue price, the following is the rule. First, we're gonna use the existing surplus until it's washed out to zero. If we still have a difference between debit and credit, then we're gonna take it from the retained earnings. Here says, any existing contributor, so when the share repurchase at price above the average issue price, any existing surplus must be used first and reduced, followed by a reduction of retained earning if and when the contributed surplus reaches zero. So this is the summary of the journal entries. This probably is the most important for today. We have the common shares. The first scenario is when the average price is equal to the price that we paid. Second scenario, repurchase of the price below the average. In that case, we're creating contribution surplus. And the next scenario is when we repurchasing share above the average issue price. In that case, we wash out using the contributed surplus first and retain earning if we still have a difference. Additional issues will be when we repurchase shares sold at later date, then we also recognize the same manner as original share sales. And the repurchase or sales of shares does not affect the net income. That's why I explained this idea with the income, earnings, profit, gain first. Because when we repurchase the shares below the price that we get, that doesn't trigger net income. That simply triggers keeping the money that shareholders pay us from before as a contributed surplus. Full disclosure has to be done, and inside trading is not allowed. Let's stop for a second. Let's have a short break, and let's continue in a few minutes. What do you say? So the next thing that we have to cover is the corporate income statement. Now, the corporate income statement, the net income, which we already talked about a little bit, net income comes from the revenue minus expenses, is probably the most important piece of information in the company. Why? Because everybody wants to know how much the company generates. Is it income? Is it loss? How much is it? So that measures the success of the operations because the income comes from the main operation of the company. Now, then you're going to ask me where the gain comes from. Gain comes from the peripheral activity, which are not the main operation of the company. That's how we should remember it, since all of you are accounting people. Income is related to the main operation of the company. Gain is related to something which is not part of the main operation of the company, but company doing it from time to time. For example, if the company has a machinery which is used for production, that machinery, through the production that the company generates, producing and selling, that's main operation of the company generate income. But if that machine at some point the company decide to replace it and sell the old machine, on the selling of the old machine, the company can generate gain or loss because the selling of the machine is not the main operation of the company. Make sense? So the income also built assets and shareholders' equity, assets in terms of cash, and the income is the one who attract the new investors. Everybody, why? Because everybody wants to get more. For that reason, income is going to have a different sections. First will be, again, sales revenue, cost of goods sold. Then we're going to get the gross margin. Gross margin is the first important part of the income statement because tells you how much you're generating simply from your main operation. Then we're going to have operating expenses, which is the normal expenses which are related to running the business. And then you're going to have your operating income. After that, you're going to have some other gain and losses. We're not talking about income here, we're talking about gain and losses. First, we're going to lose for the restructuring the operations. Second, we're going to get from the sale of machinery, which is not part of our operation now. Those are some other activities that's happened in the company. And then we're going to have this income from continuing operation before income taxes. Now, it's a requirement income taxes to be the separate line on the income statement. Once we get the income taxes, we're going to have the income from continuing operation. So now on the income statement, we cannot have two lines for or more than one line for the income tax expense. But as you can see, the income statement continues at this point. So what that means, every amount which is included on the income statement after the income from continuing operation, when the income tax expenses are shown, every amount has to be net of income taxes. So then coming the last section, discontinued operation. What means discontinued operation? Those are operations that's never going to happen again in the future. Since they not going to happen again in the future, they have to be separated from main operation of the company because we want the investors to have a clear picture how much company generate from the main operation. Something that happened during the year, which never going to happen again, that's not in the big concern for the investors. So in this case, we have operating income of 60,000. Now, since we already passed the income tax expenses, now we have to deduct the income taxes and show it or include this amount here as a gross amount less taxes. Gain on disposal, same thing. Main amount, gross amount less taxes. And we're showing those amounts. And the last one is the net income. There are a few more things on the income statement. On the income statement, if it's public company, we have to show earnings per common share. Only for the public company. For the private company, that's not requirement. And we have to show earnings per share from the continuing operation, earnings per share for discontinuing operation, and earnings per share on the net income. So now, continuing operation again is the one that helps the decision maker to predict the future earnings. That will include the results from the normal operating activities, other gain and losses, from selling items which are not part of the main operations of the company, income tax expense. Discontinued operations, This section on the income statement is divided into two components: operating income or loss and gain and loss. Every each amount on the discontinued operation, it has to be shown net of the income tax. So the tax effect has to be taken out before we show that amount. Then we're coming to the next section, which is earnings per share. Now, this is the important part. This is the second important part in the chapter. How are we going to calculate earnings per share? Earnings per share is the formula is net income minus the dividends, which is allocated to the preferred shares, minus the weighted average number of common shares outstanding. And this is the key here. This is not a simple average. This is a weighted average. So for that reason, this calculation is a little more complex. And I'm going to spend a few more minutes, a little bit extra time to explain this calculation. How this works. First one, assume that this corporation have the following common shares outstanding on the respective dates. On January to May, they have 240,000 shares. From June to August, they have 200,000 shares. From December to December, they have 210,000 shares. Now the question is, what's the weighted average number of the common shares outstanding? So what I'm going to do, I'm going to copy this and let's move to the Excel spreadsheet and do this on our own. Just give me a second. I'm going to share my screen. So this is the question. So now there are different calculations and different ways to get this calculation. If you are in class, I'm going to give you the simple formulas, but since we are not in class, I'm going to show you the formula in the Excel spreadsheet, which might be a little bit more useful for you. So the question is, we have the entire year, have 12 months, from January to December. The question is, how many shares we have? What's the weighted average number of shares from January all the way to December? There are a few ways to get this calculation. Number one is we're getting from January to May, we have shares outstanding. Let's make this one bigger too. How many shares we have outstanding? 240,000 shares. Correct? Let's put some numbers here. Now, how many months those are outstanding? January, February, March, April, May. That counts for 5 months. So, total. Let's get here total. For those 5 months, we're going to have equal to this one time 5, and we're going to get some total number, those are number of shares outstanding. Then we're going to have from June to August. And for that period of time, we have 200,000 shares outstanding. How many months are those? June, July, August, those are 3 months. And we're going to get the same formula. And then we have September to December. How many shares? 210,000. How many months we have? We have September, October, November, December, 4 months. 4 months. So, simple calculation is this. Once we get those totals, we gotta see how many months we have for the 4 year. The total here is 12 months. So that means we get those numbers correct. What's the total number of shares? 2,640,000. What's the weighted average? Weighted average common shares outstanding. And we're gonna get this number divided by 12. And we're gonna get that the number, weighted average common shares outstanding is 220,000. This is one way to calculate. There's a second way. Second way, I'm gonna go with this one. Copy and paste. So now, here, what I'm gonna do, I'm gonna push this one a little bit further on the left side. Actually, the right side, like this. And we're gonna start new calculation. Let's delete those. So, we have the number of months. Months per year. The year has 12 months, correct?
Yes, Prof.
That's gonna give us the fraction. And then we're gonna get the calculation. So first we're gonna get 5 divided by 12. Then we're gonna have 3 divided by 12. Next one will be 4 divided by 12. Once we get those numbers, we have to get 1. Let's do the calculation, we're getting 1. Because 1 is the 100%. So what we're gonna do, the calculation that we're gonna do here is simple, like this one will be equal to outstanding shares times the fraction of the months. 100,000. Then we're gonna keep going. And now the weighted average is this number. Here we just directly calculating the weighted average. As you can see, our results is exactly the same. What that means is you can use any of those calculations. You don't have to do the one and then do the next one and then do the next one. Only one. Now the third type of calculation. Let me show you the third calculation. The third calculation is like this. Now, delete those one. I have from January to December 240,000 shares for sure. That's 12. And in this case, I don't need the fraction. So actually I can copy this calculation here. I only need those lines and this one. Like this. I'm going to do this. So from January to May, from January to December, I have 240,000 shares. That's my starting point, and that's for 12 months. Then from June on June to December, my shares going down with 40. Make sense? 40 shares from 240, I'm going to 200,000. So I purchased back 40,000. So my number of shares going down to minus 40,000. That should be 40,000. But that's from January to December, from June to December. So that means June, July, August, September, October, November, December. That's 7 months. And the last one is from September to December. From 200,000, I'm going up with 210. So I issued 10,000 additional. But that's for the 4 months, September to December, 4 months. Once I get this calculation, now this number is irrelevant here. Once I get the total is 264. The year has a 12 months. So that means this one divided by 12 is going to give me the weighted average number of shares. Now, which method again? You have those 3 methods available, 3 ways to calculate the weighted average shares outstanding. Which one you're going to choose? It's your choice. And each of those methods going to bring you to the same results. Choose the one that is easy for you. Use that one. Make sense? Now let's go back to the slides and see how the slides dealing with this problem. Obviously, will be to some extent will be repetition what we already covered. So let's go one after another. First calculation is we get 240,000 shares, which are outstanding from January to May, which is 5 out of 12. So they're getting the fraction of the months, and that's 100,000. Then we're going 200,000, which is fraction of the months, 3 divided by 12, 50. 210, fraction of the months, 4 divided by 12, 70, 220. That's the first calculation. Second calculation. On the second calculation, no, that's actually, no, they're discussing only one calculation. They're not showing anything else. Now, let me see, is there anything else? No, there's nothing else. Now, watch this. Now they're going to go with the, what's going to happen if the company declare the share dividend somewhere during the year. How this going to affect the weighted average? Well, the general rule is we assume that the 10% share dividend happened in September 1st. So at September 1st to December, we're going to treat the shares as the way they are outstanding, including the share dividend. How about the months before? The months before, we have to apply the 10%. So basically, we're treating the, for the calculation of weighted average number of shares, we're treating the calculation as the stock dividend was applied from January. Now, one way to do it is the way that they're showing here. That's one way to do it. To go back and to put the 10% fraction from the period from the January to May and from June to August, and from September to December to carry forward with the new number of shares, which including the share stock dividend. That's one way. The other way, it's a little bit more simple, and including this thing. Gonna go back to our Excel calculation. The other way is do the calculation the way we done it. Do the calculation the way you done it. At the end of the year, at the end of the calculation, put the stock dividend. Stock dividend. And in this case, the stock dividend was 10%. Let me increase this one so we can see it. Stock dividend was 10%. So what I want you to do is apply that 10% is equal to number of shares times 10%. And that will be the weighted average common shares with the stock dividend included will be 242,000 shares, which is exactly the number on the slides. And let me see if I share my screen. I don't think I'm sharing my screen, do I?
Not, bro.
So let's share my screen again. Watch this. Let's go back. So first, get the calculation, pretending that there is no stock dividend. Then put the stock dividend at the end of the calculation. Apply the 10%. Calculate how much is the 10% stock dividend. Calculate the new weighted average cost, common shares, and you're going to get the same number. Let's show you the proof of this. And in our calculation, we're getting exactly the same number that they get. And this is simple math. There's nothing scary with this. We're going to practice next time a little bit more on this one. Same thing is with if you have a stock split. Now, the stock split has to be applied from January all the way to December. So from the period when the stock split happened, from that point till the end, we are using the numbers after the stock split. But from before, we have to apply the stock split that the stock split happened from January. Now, the simple way is the same way as we're doing the calculation on the Excel for the stock split. Let me show you quickly. So I'm going to use again this part of the calculation. Control C and Control V. Now we're not going to have a stock dividend. We're going to have now stock split. And our stock split is 2-to-1. So that's not 2%, that's 2. Number 2, which will be this one. So in this case, the weighted average number of shares will be equal to 440,000, which should be exactly the same number that they're showing on the slides. Let's compare 440,000. That will be the other way to do it, simply a simple way to do the stock split and stock dividend calculations. Now, how are we going to calculate the earnings per shares? I'm going to leave it for the next time. And we're going to see next time, we're going to capture again those two important things with the creation of the contributed surplus, clearing the contributed surplus and applying the retained earnings, and the calculation for the common shares, or the weighted average number of the common shares. And that's where I'm going to stop today.